This chart shows a seemingly perfect flag pattern breakout. You spot the setup, execute the trade, and instantly watch the market reverse, hit your stop loss, and wipe out your position. Standard textbook definitions often fail in the volatile reality of the foreign exchange market. In a live environment, false breakouts and market noise regularly shred strategies based on simple memorization. While amateurs focus on flat, two-dimensional shapes, professional traders read the underlying psychological story, the actual battle between buyers and sellers that gives those shapes meaning. We are going to deconstruct the exact anatomy of a high-probability continuation trade, from the first spark of momentum to the final profit target, using institutional-grade analysis. Mastering this structural anatomy allows you to separate genuine, profitable trend continuations from the costly noise of the retail markets. Every valid continuation setup begins with one non-negotiable prerequisite: the flagpole. This diagram illustrates a valid flagpole. It requires a steep, vertical sequence of large-bodied green candlesticks, indicating a massive, rapid burst of buying conviction. If the price action leading into your setup is choppy or slow, walk away. Without that swift, aggressive directional intent, any pattern that forms next is invalid. Following that impulse, the market pauses. Early buyers secure profits, while new entrants wait, creating a slight downward drift, the flag. Alternatively, price action can compress between converging trend lines into a symmetrical triangle, a pennant. To remain valid, the consolidation structure must stay within the upper third of the original flagpole. If it retraces more than 50% of that initial thrust, the setup is dead. This specific pause represents a strategic accumulation of market energy before the dominant force resumes control and drives the price higher. The breakout zone is the upper resistance trend line that contains the consolidation pattern. For breakouts, the rule is strict: never enter on a mere pierce. Wait for a decisive green candle to close its body completely outside the boundary. Then place your stop loss directly below the consolidation's lowest point. To calculate where to exit, use the objective pole measurement technique. Measure the exact pip distance of the original impulse move, then project that identical distance upward from your breakout point to find your target. Locking in these mechanical parameters for risk and reward before execution completely removes emotional decision-making from the trading process. To avoid market traps, you must demand secondary confirmation data beyond price action. First, analyze the volume story. Trading volume should visibly decrease during the consolidation phase to prove the market is resting. This chart shows the ideal entry. A valid breakout requires a massive, immediate surge in volume, confirming that institutional players have committed to the move. You can also use the Relative Strength Index, or RSI, a metric that measures the speed and change of price movements. If the RSI stays above the 50 line during the pause, the underlying momentum is still bullish. Layering price action with volume analysis and momentum indicators transforms a hopeful guess into an evidence-based, high-probability trade. Even a mathematically perfect setup on a 1-hour chart can fail if you ignore the larger market environment. Zooming out to this daily chart reveals the risk. A small flag's upward trajectory might be aiming directly into a massive historical resistance zone. Multi-timeframe analysis ensures you aren't buying into a ceiling. Regardless of the setup's quality, never risk more than 1 to 2% of your total capital on a single trade. Successful trading of flags and pennants relies on a combination of precise pattern recognition, volume confirmation, and macro awareness. Institutional trading depends on systematic frameworks. You can practice these disciplined tools right now on the FXNX platform, featuring 0.0 pip spreads.